I remember now. Gotta show it to you like this. All right, so here we are at chapter 7.1, okay, where everything that we learned in chapter 5 and chapter 6, what I want you to do is I want you to kind of put it aside, okay? We will be visiting it again when we get closer to the exam, but we definitely need to make sure that you guys don't get the both of these concepts confused, okay? One's going to be different. Now, what you're going to be noticing that chapter 7 and chapter 8 is more or less going to be very similar to chapter 5 and 6, right? We are still dealing with inventory, but this is the difference between the two and how we keep track of them, okay? So, once again, we're looking at merchandising inventory, which we talked about before, right? Where our assumption is that we're going to purchase our goods, right, with cash, and then we convert those goods into sales and those sales into cash, okay? And again, the more typical businesses that do this is going to be the retailers slash, wholesalers, merchandisers, those type typical stores that sell those products and goods to services to customers. Okay? And again, right, we're going to revisit this where what is going to be included in the cost of inventory. Everything's going to be included, including freight, sales tax, if any, shipping and handling, okay, expedited fees if there is any storage fees are going to be part of the cost of inventory, okay, and of course, as well as the actual selling purchase price, okay. So we talked about the two different tracking methods, right? We talked about periodic and we talked about perpetual. Now here's the difference. We are done with periodic. So that means we are now going to be moving into perpetual because we've already learned everything there is needs to know when it comes to periodic inventory. So when we do perpetual inventory, right, the definition of perpetual inventory is to constantly update your inventory, right? That's what perpetual means. It means to be constant, right? Now, if I'm constantly updating my inventory, what does that entail? Every purchase that you make, update my inventory, right? I just received items, so therefore I increased my items. Every time I sell a product, I sold on them. Therefore, I got rid of my inventory, so I need to update my inventory. Okay, so therefore I need to subtract those amounts. Okay. And of course, here's a huge, huge difference between periodic and perpetual. Perpetual inventory, we don't need to make an expense. Everything is just going to be going straight into inventory. Okay, that's the huge, huge differences. This one, you recognize that you purchase inventory, straight to inventory. When you sell something, you got to take it out directly from inventory. Okay? All right, and that's the huge difference here. So let's go ahead and dive right in to take a first look of how to purchase perpetual inventory. Okay? So the example here is going to be that on July 1st, XYZ company purchases 100 toys from, costing $5.65 each, okay, with a freight of $100, okay, and we're going to record this transaction. So in this case, right, we understand we just made a purchase of toys, right? In this case, I want to be very, very, very specific to what items that I purchase. That's another difference when you're dealing with perpetual inventory. But again, you can use inventory if you want to, like the general inventory account called inventory, right? But in this case, if you're selling more than one product, you shouldn't just associate everything as inventory. You should associate it by what those items are. But but for most general information, right, your assumption is you're going to place everything into inventory, okay, including all extra costs it takes, because that's part of the cost of inventory, right? Sales tax, freight expense, shipping costs, those are all considered part of the cost of inventory. So that's exactly what you're going to do. You have those extra costs, you're also going to be dumping that into the inventory account. Okay? So in this case, I have inventory toys account. Okay, and because I didn't specify how I paid for it, right, whether it's cash or accounts payable, so this is what we're going to do. We're going to dump everything into inventory. So in this case, we're going to include the purchase price of 100 toys at $5.65, and also include the freight cost, because that is part of the cost of inventory. So in this case, what we're going to do is we're going to shove everything into inventory into one account. So that's what we're going to do. We're going to calculate the $565 plus the $100 freight to get a grand total of the $665. And they all go into one account. Okay? Straightforward, easy. Any questions here? Okay. All right, 7.2. Well, of course, if we have the means to be able to purchase our items, we also have a means to be able to return our items as well. Okay? There are many reasons why you would need to return a purchased item, because for any reason that it is the wrong color, the wrong order, wrong item, or they simply broke it and something happened during shipping, maybe they lost a few items while shipping, any reasons, or even if you have another competitor or another vendor in mind that sells the items a lot cheaper but has the same quality, okay? Those could be any reasons to why you would need to have, request a refund, okay? Now, of course, when it comes to vendors, right, they're the ones that saying, hey, since you do buy in bulk from our company, right, they will try to keep you as a company as part of the business, because we might be a large part of their sales if we're buying items in large quantities. So if we're buying in bulk, right, if we're buying thousands and thousands of items, then this vendor is going to ensure that whatever we ask for is going to be met, right? So if for any reasons that we have to return, they will give us discounted prices, special offers, unlimited returns. And of course, if you're completely unsatisfied, you should be able to get your money back guaranteed. Okay? So let's take a look at an example here, okay? In this case, right, it is January 1st, and you decided to purchase 100 coffee mugs on an account from Cuppies Co. Each coffee mug is $1.25. Freight costs you $100. So let's record this transaction. So let's practice this one, okay? In this case, how would I journalize this?
We put the date.
Okay, January. Good. Okay, January 1st. What's next?
Purchase gonna be new purchase expenses.
No.
Right. Record this transaction.
We're not on periodic inventory.
We need to do the same last one, correct?
Yes.
We put the freight of one.
No.
Inventory, which would be the coffee mugs.
Yes. That's the huge difference between periodic and perpetual, is everything's going to go straight to inventory.
Oh, no. Okay, okay. I got it.
Okay? So in this case, coffee mugs, right? That's my inventory account, coffee mugs. And because I paid it on an accounts payable, it's accounts payable. Now, how much is going to go into my coffee mugs?
$2.25.
$2.25, right? We're going to include the selling price of the 100 mugs that I bought at $1.25, which gave me a total of $125, plus my freight of 100, right? Because this is part of the cost of inventory. So I'm going to shove everything into inventory. So therefore, there you go. I have $125 plus $100 freight. So therefore, that's going to give me a total of $225. Okay. Now let's take a look at this. So when we received the items, right, we found that 10 of those coffee mugs were broken. Okay. And you, of course, requested for a full refund from the vendor, okay, for the broken items, and of course the vendor grants you the full refund. How do I record this transaction now?
So it would be coffee mugs and accounts receivable.
Accounts payable, right? Because that was we owe money. We used accounts payable in the first place, and that's correct. Good, because in this case, right, if we placed everything into inventory, that means everything's going to come out from inventory. So in this case, right, write that concept, perpetual inventory, right? If we put everything into inventory, that means we could take it out from inventory. And that's exactly what we're doing here. We have a full refund on those 10 broken mugs. So in this case, right, we didn't pay for it yet. So therefore, we need to reduce how much we owe them because, right, we haven't paid for it. They're not going to give us cash for something we didn't pay for. So in this case, they're going to reduce the liability, the amount that we owe. And we're going to take that amount out directly out from our inventory account, which is the coffee mugs. So in this case, 10 times $1.25, right? You can't include freight. We can never include freight for any returns. So this doesn't, just because this is perpetual inventory, it still doesn't make a difference. You're going to calculate it by cost per cup. So in this case, the cup cost me $1.25 each. So 10 times $1.25 gives you $12.50. Okay? Much more easier. Instead of having to be complicated, have to create a contra account, then create a contra account. This one's straightforward. You only have one account and one account only, right? Which is your inventory account. Okay. So let's go ahead and take another look at another example. What if on that same day, right, January 5th, when you end up looking into your inventory, you actually found that 25 of those coffee mugs were the wrong size, okay? And of course, you requested a refund, okay, on these extra large coffee mugs, okay? And the vendor has offered you an additional 20% off. So they convinced you to take in an allowance instead of return the product back to them. Because in this case, right, they already sent you 25 of those coffee mugs. And of course, there's nothing wrong with those coffee mugs. They're just a different size. So they can convince you to say, hey, there's nothing wrong with these coffee mugs. They're just a different size, right? You could still sell them, right? You could still, you could still use them, okay? And because I made the mistake, I'm going to offer you an additional 20% off to reprimand my mistake by accidentally sending you the wrong item. And in this case, you're willing to accept it. So you're willing to accept the coffee mugs and willing to accept a 20% discount. So in this case, how am I going to journalize this time?
Coffee mugs.
You're still going to be using the inventory account coffee mugs, right? Because everything that goes into coffee mugs, well, you only have one place to go. So you're going to have to take everything out from coffee mugs. And in this case, I paid these 25 mugs at a discounted price. Okay? So I have to figure out, well, since I'm getting discounted 20%, right, I need to figure out what those 25 mugs at $1.25 was. And it was $31.25. And I need to figure out what 20% of that is. That's the refund I'm getting. I'm only getting a portion of the money back. So in this case, 20% of $31.25 gives you $6.25. Okay?
So there's no purchase return and allowance. That's only for periodic.
Only for periodic.
Okay.
So this one's much more easier because you don't have to create an account after an account after an account. All you have to do is just remember one thing and one thing only. Your inventory account. Which one is it? Because you can have multiple inventory accounts, right? You can have, obviously, if you sell more than one item, you'll have coffee mugs, you'll have tumblers, you'll have coffee grounds. I don't know. Okay? You'll have more than one item in inventory. And in this case, when we're using perpetual inventory, you only have that one account and one account only. Okay? Any questions here?
No.
Okay. So chapter 7.3 here, perpetual discounts. Okay. So, of course, this is familiar, right? We've seen this before. This is terms, okay? Terms is 2%, 15, net 30, okay? All right, and how we understand this is if you pay within 15 days, right, you can take a 2% discount, okay? If not, you must pay the whole entire amount in full in 30 days, okay? So this is time sensitive. Now, there are two ways that we can recognize this, right? We can either recognize it as the net method or the gross method, right? We've seen this before. Very similar concepts, except the difference is we're not journalizing it as a purchase expense. We're going to be journalizing it as inventory, okay? However, right, the net method, right? Straightforward, right? You look on your paycheck, right? Your gross amount is what you've earned in general. Your net amount is what after taking all the taxes out, how much money are you left with? Same idea here. The net method is you look at what you purchased and you take the discount immediately. Whereas the gross method, you record it at original cost and then you wait till you pay for it. And if you made the discount period, then you pay for it. Okay? So let's take a look at the net method. Okay? So in this case, right, when it's February 1st, we decided to purchase 100 coffee mugs on an account from Cuppy's Co., right? And each cup costs $1.25 with a freight of 100. So in this case, there is terms of 5% 10 net 30, okay? So how do we record this transaction? Okay? So we're using the net method. Okay? How are we going to record that we purchased inventory?
Coffee mugs.
Coffee mugs. Good, right? In this case, that's exactly what that the inventory is coffee mugs. Now, in this case, how am I going to discount this? Because I'm using the net method, right? How am I going to calculate this? We can only discount our selling price. So in this case, my original selling price, or my original purchase price, excuse me. My original purchase price was I bought 100 mugs at $1.25. So in this case, that gave me a total of $125. But because I'm taking advantage of this discount, I need to calculate what 5% of $125 is, which is $6.25. So what I'm going to record in my books is I'm going to record that I am going to purchase my inventory for $218.75, right? I can't forget about the freight. The freight, once again, is going to be included into inventory as well. So in this case, yes, my original purchase price is $118, but I can't forget the freight of $100. So that's why I am purchasing it at $218.75. Okay. Right now it is February 9 and I end up making a payment. So in this case, right, straightforward, since I made within the discount period, I just pay them $218. Straightforward, right? However, what if I accidentally miss that discount period and I use the net method to record the purchases? What happens here? What happens here? Okay, we have an accounts payable, right? We got to pay for what we owe. But what else?
Coffee mugs.
Coffee mugs. Because in this case, I missed the discount, right? So I have to put that discount back into my coffee mugs account because even though I recorded it that I paid or that I owe at a discounted amount, in this case, I end up missing my opportunity. And now I have to pay for all of those coffee mugs for full price. So in this case, I'll be paying $225 because that's what I should owe, right? The $218 is my discounted amount. But I gotta put back the $6.25 back into my inventory because I missed the window of opportunity to take that discount. So basically, I paid for the coffee mugs for full price. Right? What about the gross method? Gross method is going to be the mostly commonly used one just because, again, we're not in the business. We haven't been in business for a long time. So typically, you would generally use the gross method just because you don't know yourself. You don't know the business well enough to be able to say, yes, I can make my payments on time. Right? Yes, we would love to all say that, but at the end of the day, we have other priorities such as we have to pay our rent, we got to pay our employees. That's definitely way more important than paying your inventory. So in this case, right, when we have here this the same exact example, we purchase 100 coffee mugs at $1.25 each and the freight of 100 with the terms of 5% 10 net 30. Using the gross method, we just recognize it at full price. Okay? And then when we meet this condition, because we have to remember terms is a condition, right? You have to pay in order for you to receive the discount. So in this case, scenario 1, it's January 9, right? We purchased it on January 1st. So we pay within the first 9 days. So therefore, we need to calculate what this discount is because we met the condition. So how are we going to journalize this? We're going to recognize that we owe Cuppies Co. $225, right? But because I'm making the terms, I'm not going to pay Cuppies Co. for all of the inventory, I'm going to take advantage of that discount and pay them less. So what I'm going to do here is I'm going to calculate how much the discount's going to be, and then that's going to determine to me, okay, my discount was $6.25, so I have to take that out from my inventory because I've already placed my inventory at full price. Now that it's discounted, right, I didn't pay for my coffee mugs at full price, so I have to take it out from my coffee mugs. Okay. And of course, if you end up missing the payment or missing the discount period, you just end up paying for what you owe. Okay. Any questions here?
No.
So, welcome to chapter 7, okay, perpetual inventory, where all we need to do is focus that when we purchase something, right, it's all going to go into one account, the inventory account, okay? Every cost, every freight cost, every sales tax or anything that's extra that's in regards to inventory is all going to go into the inventory account, okay? And how do we deal with returns and allowances? So again, right, if I make a return, then I take it out from my from my inventory account, right? Same thing with an allowance, right? If you're journalizing it as regular as you acquiring it into inventory, you only have one account that you can take out from, which is the inventory account, okay? And of course, we talked about what happens when we have discounts, whether you're using the net method or the gross method. Terms is a condition that needs to be met for you to be able to record this. Okay. All right, so let's go ahead and dive right into the exercises here. Okay. So, all right, number 1, journalize. Okay. On April 5th, we end up purchasing 1,000 units at $5 each. Freight cost $100 on an account. Terms was 5%, 10 net 30. Okay, so in this case, April 5th, we purchased 1,000 units, okay, at $5 each with a freight of 100 on an account. So, how should I journalize this? Inventory, right? Because that's what we just acquired, inventory, right? And what else? Right? Because we placed it on an account. Now, how much is my grand total that I'm going to be putting into my inventory? What is the grand total I'm going to put into my inventory?
5,100.
5,100, right? Because I bought 1,000 units at $5 each, which gives me 5,000. I have to include the freight of 100. So therefore, what I'm going to put in my inventory is 5,100. Okay? And that is exactly how much I owe. Now, what am I going to put in my notes here? I'm going to say that I purchased 1,000 units at $5 each, okay, on an account, and I was given terms of a 5% discount if I pay within 10 days. If not, it is the whole entire thing is due in 30. Okay. Then April 7th rolls around and we end up we end up returning 200 damaged units for a full refund. So on April 7th, we end up returning 200 damaged units for a full refund.
It would be inventory, accounts payable, inventory, both at 1,000.
Okay, good. So in this case, I need to reduce the amount that I owe. And in this case, because I placed into inventory, I need to take it out from inventory. Okay. Now, 100 or 200 times $5 is 1,000. Okay. And of course, you're going to make your note here saying you return 200 damaged units at $5 each. Okay. So then let's see what happened next. April 10 rolls around and you end up purchasing 750 units at $5.75 each with a freight of 75 on an account. Terms are also 5%, 10 net 30. So in this case, what am I going to do for here for April 10? How am I going to journalize this transaction?
Inventory, accounts payable at 4,387.50.
Okay, so okay, good, right? Because in this case, right, if I calculate this, right, if I bought 750 units at $5.75 each, we know what that is. That's 4,312.50. Okay? But we have to include the $75 of freight. So in this case, right, my grand total that I have here is 4,387.50. Is that right?
Yes.
Okay. Right. And of course, I need to make a note here that I purchased I purchased 750 units at $5.75 each. Okay. And of course, I have to also include that I will receive a 5% discount if I pay within 10 days. If not, the entire bill is due in 30. Okay. So then April 15 rolls around and we end up returning 50 broken mugs due to shipment for a full refund. So in this case, we have to go ahead and return 50 because they were broken due to shipment. So in this case, how am I going to record this time?
Accounts payable, inventory at 287.50.
Okay. So in this case, right, I'm just going to copy this down here just because I can. And we are returning 50, and it's not damaged, it's broken. Okay, at $5.75 each. So if you calculate 50 times $5.75 each, you get $287.50. Good. So then let's see what's next. April 20th rolls around and we end up purchasing 200 units at $6 each, with the freight costing $20 on an account. Terms are 5%, 10, net 30. Okay. So in this case, it's April 20th. How am I going to journalize this?
Inventory, accounts payable, both for 12/20.
Good, right? So in this case, I purchased 200 units at $6 each, okay? Which gives me 1,200. Plus, I have a freight of $20, so that's going to give me $1,220. Okay. So then on April 22nd, 25 of the units were the wrong color, and we are willing to accept a 20% discount. Okay. So somehow the vendor sent me 25 units that are different colored, convinced us that you can still keep them and still sell them, but we will give you 20% discount because we sent you the wrong item. Okay. And of course, we were willing to accept. So how am I going to journalize this? Okay, so in this case, right, they sent me the wrong product for 25 of them, and I'm willing to accept a 20% discount.
Accounts payable and inventory.
Good, accounts payable and inventory, right? We're going to take it out of inventory. Now in this case, I get an allowance on these, was it 50? 25 units. So in this case, an allowance on 25 units. Okay. And they cost me $6 each. Okay. You could put wrong color at $6 each for a 20% discount. So in this case, how am I going to calculate this? If 25 of the units were wrong and they cost me $6 each, and I'm only getting 20% of my money back. How do I calculate this?
25 times $6 is 150,
Mm-hmm.
and then 150 times 0.20 equals 30.
Gives you $30 back. So in this case, it's exactly correct, right? We're going to figure out how much the total cost of what I'm refunding or what I'm returning. So 25 at $6 each, which gives you $150. And because I'm not getting the full $150 back, I'm only getting 20% back. I need to figure out what that 20% is, which is $30. Okay. Good. April 25th, we end up purchasing 500 units at $6.25 each, with the freight costing $50. And once again, you get the same terms, 5%, 10, net 30. So in this case, how should I journalize this?
Inventory, accounts payable.
Inventory and accounts payable, right? We purchased 500 units at $6.25. So in this case, how much is that going to give me a grand total of?
$3,175.
Right? If you take 500 times the $6.25, you should get $3,125. Plus the $50 freight is going to give you $31.75. Okay? Good. Last thing that we have here is on April 30th is you end up making a payment for all 4 purchases. Write 4 separate checks. So in this case, we're going to write 1 check for every purchase. So in this case, my very first purchase that I made was on April 5th. I purchased 1,000 units, but on April 7th, I end up returning 200 of them. So in this case, let's take a look at my journal. Okay. So here I owed 5,100, but I end up returning $1,000. So in this case, how much do I owe?
4,100.
We owe 4,100 for this purchase. So that's exactly what I'm going to do. I'm going to write my first check saying I need to pay for this. Now, how am I going to journalize that I'm going to pay for what I owe? Checking, good, right? So accounts payable is what I owe, and checking is what I'm going to place here. Now, let's take a look here. I was given terms, 5%, 10, net 30, okay? So in this case, if I'm making a payment as of April 30th, right? Did I meet the discount due date?
No.
No, I missed it, right? But at the end of the day, I still had to pay for it because I bought it on April 5th. So therefore, I have 30 days. So that means May 5th would be the day that I have to pay for it. So at the end of the day, I still paid for it on April 30th. So in this case, I need to recognize that I owe $4,100, and that's exactly what I am going to pay is $4,100. And then I'm going to go ahead and say payment for purchases on April 5th, check number 1. Okay? So then let's see what happened next. Okay, my second purchase was on April 10. We purchased 750 units, but we end up returning 50 of them because they were broken. So let's take a look. April 10, right? We owed $4,387.50, but we end up making a refund for $287.50. So how much do I owe for my second purchases?
4,100.
Another 4,100. Now in this case, I was also given terms that I would receive a 5% discount if I paid within 10 days. If not, the bill is due in 30. So in this case, did I make my discount due date?
No.
No, because I only had 10 days, right? I had to pay on April 20th, but I'm paying on April 30th. So in this case, I also missed the discount due date for this one as well. So therefore, I need to cut my second check. Okay. So again, it's going to be the same. It's going to be accounts payable and checking. Okay. Accounts payable and checking. Okay. This time we're making a payment for purchases on April 10. Okay. Check number 2. Okay. And it's for the same amount, 4,100. Okay. So then let's see what happened for the third purchase. My third purchase I made on April 20th. We purchased 200 units at $6 each with a freight costing $20. However, we end up getting an allowance for 25 of those units, okay, which were the wrong color, but we end up getting a 20% discount back. So let's take a look at that transaction on April 20th. Here we are, April 20th. I owed $12.20, but I end up getting my 20% refund for $30. So in this case, how much do I owe?
1,190.
We owe 1,190. However, let's take a look here. We were also given terms. We would get a 5% discount if we paid in 10 days. If not, it's due in 30. I'm making a payment as of April 30th. So did I make the discount due date or no?
Yes.
Yes, because 10 days, I made it on the very last day of my discount. So that means I need to take an additional 5% discount and then I can pay. So in this case, how am I going to journalize this? Right? We have an accounts payable, right? Which we recognize to be a total of, excuse me, $11.90, right? That's what we owe. Right? We purchase things at $1,220 and we end up getting refunded for $30. So therefore, I owe $11.90. So in this case, I have to also recognize my discount. I have to take 5% off of my discount, right? So in this case, how many items did I purchase?
So it would be 500 times 625 times 5%.
5. No, we're not on that one. We're on the previous. Oh, we're on the one before that.
Oh, so 25 times 6 times 20%.
We're not on that one. We're on the 5% discount.
Oh, that's the one I said, right? It's 500 times 625.
Well, we already
And
did
then-
we already did the allowance. This is the
Okay,
this
so
is the
then-
discount.
So that would be times 0.05.
Yes. Now here's the difference though. I owe $11.90. How much of that can I actually discount? Because don't forget, we originally purchased it at $220 or $12.20, and I end up refunding 30 of those dollars back. So with the 5%, which amount can I actually discount?
The 1190.
Not $11.90. What does $11.90 include?
The freight.
How much is the freight?
Was it 20?
$20. So in this case, I have to subtract $20.
So it would be 1170.
$11.70 is what you can discount, okay? You could also do it the other way, right? By taking your, 200 times 5, which was what, 1,200, minus your refund of $30 gives you $11.70. Right? So in this case, I can only discount $11.70. Right? I can't take a discount off of my shipping. So in this case, what is 5% of $11.70?
$58.50.
$58.50. Okay, so in this case, what account am I going to take this $58.50 out from?
Inventory.
Inventory. Good, excellent, right? Because these are now discounted. Okay. And last but not least, I need to cut a check. So, checking. So, how much am I actually going to be paying?
1,131 with 50.
1131.50. 1131?
Yes.
Okay. And of course, I'm going to go ahead and make a note here saying that payment for purchases on April 20th. Okay. And what I'm going to make a note here is received 5% discount. Okay. Using check number 3. Okay. Now the last but not least is going to be the last purchase on April 25th. Obviously, there's no returns or any allowances here. Okay, so in this case, I purchased it, so this is what I owe. And of course, did I meet my discount due date? Yes, because 10 days after the 25th would be May 5th. So in this case, I do need to also calculate my 5% discount off of this one as well. Okay? But in this case, right, I owe $31.75. Okay? How much is my discount for? What can I discount?
How much was the freight?
The freight for this one was, okay, the freight was $50.
Okay, so we could only discount off 31.50.
$31.25.
No, 31.25.
Good. Right? So your journal is going to look identical to the previous one. Okay? Because in this case, how much do I owe? $31.75. But I can only discount off of $31.25. So in this case, what's 5% of $31.25?
$156.25.
$156.25. Okay. So then how much is my check going to be written out for?
$3,018.75.
Okay. Hold on. You said 156.25, 156.25 minus 3,001 75. Yeah. Right. Good. So then payment on purchases made on April 25th. Received a 5% discount. Check number 4. Right? Good. Any questions in regards to the chapter 7.1.2 and point 3 exercise? See, we got to do the perpetual purchases. We returned, we got an allowance, and we got the discount. Any questions?
No, no questions, but I want to say nicely done, Stacy.
Oh,
Sure.
yeah, good
Thank you.
job.
I'm using the calculator, so that's